So it's a pleasure to be with you and to share with you also a little bit how we see the European and especially also the German equity markets. And we are definitely at a very interesting point of time because we think that I would call it the low-hanging fruits of the recovery rally are harvested, and we are in for a more interesting environment. So I will touch upon the macro side in Europe, which is challenging, especially also for German economy, problem for the whole of Europe. And then I will move to the market side. So I will start with the macro, focusing also a little bit on the global stuff, because we all know that the German economy is very much dependent on the global business cycle. And then I will move to the equity markets. But let's start with what happened year to date. And we are talking a lot about crisis, but if we look here, we have to see what crisis. Stock markets had a rather good performance year to date. And what is very interesting, Nasdaq performed very nicely, but overall Europe performed also fairly nicely, and in some parts even outperforming US markets if we take the Dow Jones Industrial. And as you see here, the German equity index was not underperforming the European index. Even Germany is currently the weak spot in Europe. So we shouldn't draw, I would call it, too easy conclusions from the current economic weakness in Germany to the German equity market performance. But let's start, let me say, with the more concrete macro outlook for, let me say, the markets framing that we are foreseeing. And what we have to accept that we are heading for the lowest real GDP growth in the world economy, talking about Euro area, US and China, since the global financial crisis. And yes, it's a mixture of second round effects of both monetary tightening, some, I would call it also structural strains in the Chinese economy, and markets are positioned for such a soft landing. We have seen this over the last few months. So if this macro scenario is playing out, we wouldn't see additional headwinds to markets from that one. Markets are positioned for a soft landing, but what you also see here, the world economy will for a longer period of time grow very, very shallowly. This means, yes, the stagflation recession will stay for longer. And the question is whether we will manage through this period without additional market hiccups or maybe even some credit or corporate events, because such a, I would call it, subdued economic development for longer implies that there could be definitely some corporates that face some problems down the road. And what we also have to understand, in Europe, we are currently talking, as you see on the left-hand side, mainly about the industrial sector, where we have an industry recession already, and this is also impacting the German economy. But we don't have a service sector recession, and a large part also of better growth dynamics in Europe outside of Germany are coming from the next generation EU investments. And here it is very important to understand that Germany as a country is not getting much money from next generation EU, but major German companies are profiting from projects and businesses in the whole of Europe. And that's why also we are not too negative from this aspect, also on the earnings capacity of German corporates going forward. And yes, Germany has a strong industry sector, but I will show this later on. The index composition also of the German equity markets is not too much geared, just let me say, to the industry sector. So coming now more to the numbers from the big picture I already sketched, as you see here, yes, we are in the middle of this stagflationary recession, with the weak point either now or maybe coming. As you see, Germany in recession this year, US in for a softening. And as I mentioned, markets have priced this soft landing. And if we don't get any negative surprises here, we would see, let me say, at least no downside pressure on markets. Even for the time being, as I will show later on, we are more positioned for a sideways movements on the equity markets. And as I mentioned, the German economy, especially sentiment-wise, is suffering from a perfect storm of cyclical and structural factors. We have a global industry recession. We have some structural weaknesses in the car industry. We have elevated energy prices. And this is not just due to the dependency on Russian gas. And the trade frictions, the globalization outlook is also weighing on the sentiment towards the German economy. But as I will show later on in more detail, we shouldn't draw too easy conclusions from this debate. So we are in for a very shallow economic growth, but economists are focused very much on the real GDP growth. And the real GDP growth, as I have shown here for the euro area, and by the way, also for the region Central Europe, is as shallow as we had it, or even less, as we had it in the aftermath of the global financial crisis, when also the euro area crisis hit the European business cycle. So we have very, very low real growth. But what is very important, we have very high nominal growth. So we haven't seen such a strong divergence between real and nominal economic growth, i.e. the add-on from inflation over the last few years or decades. And we have to accept that even we are fighting inflation and the central banks are doing their job, inflation also acts as a sort of lubricant to the economy. This means in nominal terms, things will grow. Even the real growth is very shallow. And this usually also facilitates adjustment processes, especially in certain sectors that are currently suffering from the high interest rate environment, talking, for instance, about real estate. And also this adds at least to the idea that certain parts of the price increases can be passed over also to the consumers, because we are in larger parts of Europe for decent wage increases, given the very strong labor markets. So we have a job-rich downturn in Europe. And that's why the earnings capacity of the companies could be more favorable also down the road, even maybe not as good as over the past few months, in this stagflationary recession and in this time of divergence between real and nominal growth. But the big challenge for equity markets going forward, and maybe also where markets are positioned relatively, I would call it optimistically, is the central bank performance going forward and the inflation side. As you see here, we have an inflation peak like in the 70s or 80s. The US is a little bit more advanced, as you see it also number-wise, compared to Europe on the disinflation story. And we have, I would call it, rather strong Fed rate cut expectations. I think the market is more and more positioned for Q2 2024. Makes sense if you look at the numbers here. And the Fed has a less strict inflation mandate than the ECB. So these rate cut expectations may play out, definitely 24. Whether it is already for the second quarter, let's see. But the rate cut bets are definitely key for the equity market sentiment. This means also the disinflation process, with all its uncertainties, is, from our understanding, talking about the macro, the biggest risk factor. And still, it's not totally clear where inflation rates will really settle after the easy gains of the disinflation are harvested. And I think that's why we are also having already harvested a lot of low-hanging fruits in the equity market rally currently, which was also based on strong earnings in the stagflationary recession and now the rate cut bets. And moving now, let me say, from the macro more concretely to the markets, we see the equity markets a little bit caught between valuations and alternatives. And as I will show later on, valuations are definitely more challenging on the US side than on Europe, which opens up some opportunities for European equities and on the European equity market. And I will also once again touch more concretely about the German equity market. So if we look here at the performance year to date on global markets, so not just speaking equities, but also corporate credit and sovereign debt, we see that for certain parts of the market, and you see the 5-year performance are the dots, yeah, and the bars is the year-to-date performance. We had a strong performance above longer-term averages on the equity side, also including the German market, as you see here, but definitely the Nasdaq. And what is more important, we have seen also solid performances in, I would call it corporate credit, fixed income, as you see in US dollar high yield, in euro high yield. We came to decent returns, and this in an environment where rates markets were still fairly volatile, and where you see that the performance, for instance, on the government bond side for Germany or US was still muted. But this means if we get the rate peak and maybe even the rate cuts, which had been key for the equity market sentiment, the fixed income markets will even get more attractive than the fixed income markets had already been. And this is a little bit for us capping also the equity upside structurally longer term. And that's why we don't have a super bullish equity market view, which is from our understanding also, by the way, not such a bad environment, not to go outright equities, but also to work with certificates and other structured products. And we have to understand that the recovery rally we have seen in 2023 was maybe a little bit in larger parts of the market, a reversal of the tectonic macro shifts we have seen last year, high inflation, also fueled by Ukraine war, these strong central bank responses. And you see some of the sectors that had been hit hard last year recovered this year. And we have to accept that parts of the rally on the markets we have seen year to date have been a recovery rally or a bottom fishing after a brutal last year. And yes, the impact of the stagflation recession on corporate earnings was shallower than expected, but this is a usual pattern in a stagflation recession. But as I already sketched upon, this may change a little bit going forward, because the longer the stagflation recession lasts, the more challenging it is to pass over the price increases also to the end consumer. Even we are currently in an environment of still solid labor markets in Europe. And we have to accept that corporate earnings had been supported by the nominal GDP growth, but possibly the 2024 expectations are still fairly upbeat, and possibly we are also in for a period where we have to see whether this will hold. To rationalize the figures here, you see the earnings growth of the European Stocks 50 in 22 was 23%, looks very high, but if you factor in that we had the nominal GDP growth in the euro area of 11% in 2022, looks reasonable. You see for 23, the earnings growth is 3.6 after a strong 2022, yeah, while we have a nominal GDP growth in Europe at 6.4. And you see for next year, currently the earnings expectations are for a growth of 5.9% in Europe. Slight adjustments recently, while the nominal GDP growth next year will be just 4.3%. And let's see if the market is still a little bit in an adjustment phase here or not. But given this outlook and the strong performance year to date, we are a little bit more cautious, at least short term and midterm on the equity markets, at least speaking about an outright, I would call it, long or buy recommendation. And we have a large gap now talking about German equities. which is an interesting story. And on the other hand, this divergence you see here between the economic sentiment in Germany, this is the IFO index, and the equity market performance could be also rationalized. And this does not mean that the German, let me say, equity markets have to follow one to one, I would call it the domestic economic sentiment. And even there is some correlation, and currently we have an interesting gap. So it all depends in the end how you see what the market is on the one hand making out of figures out of Germany, and on the other hand, you have to understand what the business model of large German companies is about. And it's also based a little bit on the macro. As you see here, the German economy is the major economy most open to global trade if you compare it to China or the US, so large economies, also much more open to trade than the world economy, so to speak. This means definitely the global economic business cycle is possibly much more important than the domestic business cycle in Germany. And you see, even the small countries very open to trade in Central Europe, also including Poland, are closer to Germany than we say to other big economies. And this shows the very, I would call it, outstanding position of Germany. And that's why if you want to invest and understand German equity markets, you have to understand the global economy and not Germany, the German economy. And definitely, we shouldn't be too negative. Even we have a very negative news flow and also sentiment out of Germany currently. And even if you follow the local media there, it's even, I would call it, very, very negative. But we have to understand that in this deglobalization debate we currently have, also driven by geopolitics, there is a very important component that will stay. This is the globalization among developed markets. Yes, it could be more challenging to interact between developed and emerging markets, but the developed markets globalization is still a very big, I would call it, pool for revenues. Secondly, this business model based on exports, this export patriotism is very deep rooted in the German, I would call it also political decision-making process. And the focus on international competitiveness is very strong there. And this usually leads also to very rational wage agreements. And I think this is also very important in the times of high inflation. And we shouldn't underestimate the adjustment capacities in the German economy. The swan song for this economy, I would call it, has been sung already many times before, vis-a-vis the Japanese car industry some decades ago, vis-a-vis also other European economies, and usually Germany came back. So with some, let me say, also more constructive views, thinking about the structural factors, we shouldn't be also too negative on the German economy anyway, despite the very negative sentiment and the fact, yes, they're in at least this year for an outright recession. But rationalizing those views when coming to equity markets, you see that the earnings of the DAX companies are 70–80% coming from international activities. And you see some parts of this is in the wider EMEA region, but also US. Yes, there is a certain dependency on China, very strong in the automotive sector, as you see, with 20% plus. In other parts, it's not super strong. And you see for the total China, it's important, 11%, but it's not as outstanding as in the automotive sector, which is maybe driving a little bit the sentiment. And more important, if you look at the sectoral split of the German equity market, you have also a certain chunk of activities that maybe some people don't expect to be there. So especially you have technology, you have also a lot of consumer cyclical, non-cyclical basic materials, as you see here. And the hardcore industrials are just 13–14% of the market. Even sometimes this industry sentiment and maybe the automotive industry are very much driving the sentiment here. And we also looked at the DAX index compared to the US index, or maybe also the French one, during certain periods of economic underperformance. In the German economy, this was in the early 2000 years, yes, but equity markets tend to follow more the global trends than, let me say, the domestic business cycle dynamics. Yes, the German equity market did not perform very well at the beginning of the 2000 years, but this was also a more global phenomenon, as you see here with the comparison to US indices or the French index. And otherwise, you see there are periods of outperformance, slight underperformance compared to other markets. And I wouldn't see too much structural patterns here driven by the domestic economy. But yes, you see a very important factor, also long term. US equity markets tend to outperform the European ones. This holds true from our understanding also from the very, very long-term perspective. And there are good reasons for that one, because the US is much stronger on the earnings growth side and maybe also driven by the more advanced technological business models. But at least short-term, the valuation factor shouldn't be underestimated. And this plays relatively well for the European equity markets. Given the recovery rally we have seen year to date, you see the US markets are trading well above the long-term averages on the valuation side, even coming closer to all-time highs already. And you see here the yellow line, well below its long-term average, the German DAX. So on the valuation side, European equities are definitely much more cheaper. We don't think that this gap will easily close, and structurally on long term, yes, we see US equities with an outperforming potential against European ones. But at least currently in this situation where these, I would call it easy gains from the recovery rally are exhausted, this valuation gap looks interesting and can be closed. And that's why we are fairly constructive on European/German equities. And also, if we look at the equity risk premium, so in relation to the government bond market, you see that here also the valuation side for Europe looks more healthy than for the US. And also from this perspective, we are, I would call it, constructive towards European equities, including also German equities. And for the global equity sentiment, it was also very important to differentiate what happened on the US market, and that maybe we have to have a more granular look here. And we divided the S&P 500 into two buckets. So the S&P 495, this is the S&P without Alphabet, Amazon, Apple, Nvidia, and Microsoft. And you see US markets profited a lot year to date. We call it from this AI-driven hype, ChatGPT is the name of the game here. There is some value in this concept because I think those companies are well positioned to profit from this trend and to bring it into their business model, which are maybe not just easy growth stocks anymore. So they have some defensive traits in their business models. No one will stop using Alphabet or maybe Microsoft even in an economic downturn. So maybe they turn more and more into defensive stocks, while the AI maybe now the next element of growth there. So there is a reason for this outperformance, but looks also very strong, and definitely a certain correction in this sector cannot and shouldn't be ruled out. And especially if you go to the next slide here, you see that the Nasdaq 100 performed very nicely in the recent past, also driven, let me say, by this AI hype, yes, and very much decoupling also from the usual pattern that the growth stocks and at least certain parts of the Nasdaq are still classical growth stocks, are certainly also driven by the treasury yield or rate markets development. So here's an interesting gap. And what is very important, it had been turning now in the most crowded trade, as some global fund manager surveys show here. I've taken here a most recent one from September. that US tech was the most crowded trade. And from this angle, we see also the US markets a little bit more challenging going forward than the European markets. And you shouldn't forget about the valuation topics I mentioned earlier. And that we had a very good performance of some of the tech stocks, and the tech market brings me also to a very brief, I would call it, venture into the European slash also Polish tech market. But here you have really the classical growth stock plays, so to speak. So you have one or the other company where the business model is depending also very much on one or the other project. But here, I think the Polish market and also the global market is very much following these growth stock trends. So we looked at certain Polish companies and also the broader US market, and you see there are companies with a year-to-date plus of 15-17%, but there are also companies with a negative performance, minus 30%. Yeah? And this shows that for those stocks, also the gaming stocks, very much the individual factors count. So they were not easily profiting from this very positive tech and AI sentiment. But this also speaks for what I already said. We shouldn't downplay that the big tech US companies have added more and more elements to their business model, which makes them conservative plays compared, I would call it, to classical growth stocks like we have seen them also in the gaming industry. But very interesting, definitely. Yes, also we are not very much focusing on this sector. But yeah, you see that in the gaming industry, some Polish companies are playing at least on par with European peers, be it in terms of market cap, as you see here, or on the valuation side. But here you see once again that the US is the market to be also here, and also on the valuation side, that the US market is definitely, yeah, a market that can absorb such companies. And I think this is a reflection that very long term, yes, there is possibly still an outperformance of US markets compared to European markets, but at least short to midterm, and given these valuation topics, we are not too negative on European equities and especially the German ones. But what makes us currently a little bit more cautious, and that's why we are not outright bullish, you see here an indicator we are closely following. This is the difference between bulls and bears positioning on the market, and you see 1 and 2 standard deviations also penciled in. And this is among retail and institutional investors. And you see, for a very long time, this was a disliked market rally year to date. Especially institutional investors had been positioned rather cautiously globally. Finally, they joined the train. And as I have shown very strongly on the US tech trade, it turns now a little bit sour, but this is for us also sometimes a contrarian indicator. When the equity market sentiment had been very downbeat at the beginning of the year, maybe even as bad as in the global financial crisis, we found a good opportunity to enter the market. Now we are also more on the contrarian side and are expecting at least a little bit of short-term, mid-term consolidation on equity markets. And you see currently we have all our equity market recommendations on hold. We are positioned more cautious short-term. See equity markets definitely then profiting once the rate cut cycles are kicking in once again. But you see a rather solid performance, even short-term, for European markets compared to US markets based on the valuation topic. But we would also not downplay the potential headwinds to equity markets coming from the rotation. You see our return expectations for 1 year and also for 10 years. And honestly speaking, we see similar or higher returns on the fixed income and the bond market going forward than on the equity market. And we are, I think, all aware of the fact that usually the risk attached to equity investments is higher than to bond investments. And that's why we are also a little bit more cautious on the equity and don't expect a stellar performance going forward. but still here also in this relative position in equities versus bonds, as I already touched upon, we see European markets more constructive. And I think this would be all about our views on European equities, German equities, and market talk. And as I mentioned, a soft landing, a stagflationary recession is priced. Rates high for longer is priced. The sluggish economic development in China is priced. And that even some geopolitical frictions will remain with us. This is all priced. So any further market, I would call it surprises and maybe correction phases, which should come from, I would call it surprises in those areas, and I listed them. And as I mentioned, I think the biggest risk factor for equity markets is that inflationary pressure will be more sustained, the central banks will remain hawkisher than expected, and that possibly we see no rate cuts in the US in the first half of next year. And I think here the jury is still out. And as long as we don't have too much clarity here, we wouldn't easily go outright, I would call it equity exposure. Definitely, we prefer European compared to US equities. And we are all aware that the changes to the interest rate environment I sketched are also making alternative investments to the equity markets via structured products more interesting. And with that one, I would like to close my remarks here. A big thank you for listening, and hopefully I could provide also some insights into, let me say, the German economy and business model. For me, it's always very interesting to do so. Originally, I'm born in Germany, working in Austria, and in a company very much exposed to, I would call it the European integration to Central Eastern Europe, but definitely also I'm very closely following the developments in Germany. And with that one, I would close my remarks here.